Over the years, we've had tons of questions about how did you get from 0 units to 5,000 units? And we're going to distill it down and really kind of go through the most important things that we have kind of learned over the years to get you to that 5,000 unit mark.
Welcome back, everybody, to Money Mondays, a show that we do every week on the week. Excited to have you on. We go deep dives into various topics in real estate, multifamily investing. We're here to share what we've learned and the mistakes that we've made in our career. We've done over 800 million in acquisitions over the years, over 5,000 units, and have over 150 employees. And so we've made lots of mistakes, and we're here to share them with you.
So let's get into it, folks. And ultimately, we're going to talk to you, Ferris. Over the years, we went from 0 to 5,000 units. What was some of the turning points in our journey, your career, that kind of got us from 0 to 5,000?
There were lots of them, right? I like to say, and I think there's a book called Crossing the Chasm, and I haven't read it, but I'm sure I know what it's about, right? And it's really each kind of stage in the growth, you hit a different issue you have to go solve, right? I like to say the first one for everybody is closing the first deal, right? That's obviously a big pivotal moment. You kind of go from knowing nothing to maybe knowing something. Still a lot you don't know. Then from there, right, it's figuring out, okay, how do I start to turn this into a business, not a one-off acquisition, right? And how to start to build some of the basic systems, some of the basic processes. And really that next leap, I would say, was getting an asset manager, right? Getting someone dedicated to track the deals, make sure they're performing.
Kind of getting your first employee, right?
First employee, right?
Yeah.
And so then from there, right, kind of you can actually start to grow, start to scale, and then you start to figure out what are your strengths, what are your weaknesses, right? What things should be handed off because it's so important that someone should be focused on it, or what things should not be handed off because it's too important and you should be focused on it. And I'd say that's where for us it was really kind of starting to figure out marketing and some of the other things, because again, about really refining deals or finding money, right? And so we had those relationships with the brokers. Those are a little bit more difficult to hand off. But then it became about, well, hey, how do we bring on people, help us tell our story to our investors?
Yeah, I'd say the last thing too, right, is an exit. So whenever you go from, okay, hey, I bought our first deal to we sold our first deal, I think there's still a lot of people in the market that have big brands that still haven't sold anything. So really all of their stuffs are kind of projections. We've sold 10 deals already, so our track record's somewhat cemented stone already. And so we're able to go to new investors and say, hey, we sold these 10 deals. These were the returns that we provided, right? And so that also helps accelerate your growth, right? I mean, in this business, it's all about momentum. And I think these pivotal moments along the journey allowed us to get that additional boost, right? That additional wind in our sails, to get us to 5,000.
So next question, right? What key lessons have you learned along the way that you wish you knew when you first started?
No, I think it's ultimately, and this is somewhat of a cliche, right? I wish hindsight's 20/20 in our business, right? There are certain parts or certain years in my career that I wish I would have bought a lot more. Some of these buys were tremendously good buys, right? 8, 9 caps in Atlanta back in 2017. I should have bought everything that we could have gotten our hands on, because now knowing what we know, it would have been tremendous growth. And I think ultimately one thing too is letting go of the reins a little bit. Hiring on that first team member is big, because I think in your mindset has to shift from doing all the doing to managing somebody that's doing the doing, and ultimately freeing your mindset up, or your mind space up, to do the things that you're good at. Maybe it's underwriting deals or finding deals or raising money or some other part of the process. Make sure that you're delegating that stuff out that you don't like and you're not good at, right?
Yeah, and I have 2 more I'd add. First one, we learned this one the hard way, is knowing your lender. The lender that you choose does matter.
That's huge.
They can make life easy or not. And so that's a big one. We learned that one early on in our career.
Painfully.
Very painfully, right? And then the next one is really understanding what true reserves means.
Yeah.
Reserves is not $100,000, $200,000 on a $20 million acquisition, significantly more. And so really understanding, how do you really mitigate risk and continue to do so? As an operator, typically we're going to be the first ones to put up money if we need to, right? And so you want to avoid that. So really, what do reserves look like on a big deal? And how do you, even if everything looks great in the underwriting, you love the asset, how do you still have enough to be able to kind of have a good, strong rainy day fund?
And one thing, Ferris kind of joked about it, but I think it's important. We have a good partnership, right? But we don't agree on everything, and that's good, right? That's healthy. But I think people have a tendency, they come out of these boot camps, they come out of these various real estate conferences where they're like, oh, I'm gonna hop in and partner with this guy or this gal, and we're gonna do deals together. Well, what they don't realize is that it's almost like a marriage. And if you don't have the right partner on a marriage, we know where that's gonna end up too. And what I was saying over the weekend, we were at another event, and I was telling people like, hey, look, the divorce is just as messy, right, with a partner, right? So make sure that your goals are aligned, your work ethic's aligned, that you're both gonna go out there and hustle and you have a goal in mind. You know where you wanna go and you're all going to the same direction. Because you'll have somebody that hops in with this partner and this guy doesn't do anything and this guy's doing all the work, but they have to still split it 50-50.
Knowing your lender, the lender that you choose does matter.
That's huge.
They can make life easy or not, right? And so that's a big one. We learned that one early on in our career.
Painfully.
Very painfully, right? And then the next one is really
doing all the work, but they have to still split it 50-50. That's not
my
fair.
life right there,
That's
man.
not
I wish
fair.
I would have seen this video earlier
This guy's so generous to me, my friend, so generous. But it's important because again, if you got the wrong partner, it's gonna stall your growth out very much, right? So, all right, next big question that we've got. Scale it from 0 to 5,000 units, right? Can you discuss how you've identified these partners? And ultimately, what have they contributed to the growth? And I think we've had some great partners along the way.
No. Yeah, in our career, we've had different types of partners for different situations. And we always do this presentation we like to talk about, which is the different ways to add value in multifamily, right? And it is about adding value. Even Ben, I add value to him. It's a great partnership. Both people have the same goals, both people have the same work ethic, and you get things done. We have different strengths, different weaknesses, and you ultimately are looking at what are things that I'm good at, what are things that I'm not good at, how do I find someone to complement that? That could be an immediate partner, right? That could be an outside partner, right? Where you're doing what we call deal partners, right? And so the big ones that we talk about, again, we're not gonna dwell on them. We've done other episodes, go check them out if you kind of dive into them, but really talking through what does it look like to help with balance sheet liquidity?
Yeah.
What does it look like to help with earnest money? Sourcing a deal, boots on the ground, equity, all of these are different ways to find a partner. And we've had partners in all aspects of these. So again, you're trying to figure out what is my gap right now and how do I find someone where it's a big pie, we slice the pie, we all get something bigger, better done together.
And one thing I would mention when you're first starting off, right? Some of the things that you might be lacking, unless you're just independently wealthy, is that net worth and liquidity piece, right? Putting up hundreds of thousands of dollars in earnest money, that's tough. And then ultimately raising the equity. Like I can think of various partners along the way that have helped us bridge those gaps. And those were, if we didn't have those people, we wouldn't have had the momentum that we got, and even to this day, we have a great partnership and they provide a lot of value to us and that allows us to grow more quickly, right? So you have to figure out what you're lacking, what you need to get that momentum, and then you need to go out there and find a good partner to plug that hole, right? All right, so last question. Many aspiring syndicators wonder about the financing, right? How do you secure the necessary, capital stack and manage that substantial number of units and ultimately those number of loans? How do you develop those relationships? How do we put those loans in place? And how has knowing how the financing piece kind of led to some of that growth?
Yeah, so there's a lot in that question to unpack. But first and foremost, understanding the market that you're in. What does the lending environment look like? What do rates look like? What does leverage look like? What do all of the different debt options look like? That's first and foremost. Then you start to figure out what deals can I back into, right?
Yeah.
Based on that market. What is pricing of those deals? And can I find a marriage? Ultimately, whenever we buy a deal, what are we ultimately doing? It's financial engineering, trying to find a marriage of debt to assets, right?
Yeah.
Based on those, either the existing or future projections of those assets. And so ultimately, right, you need to understand the numbers. You need to be able to dig in. Both Ben and I, we both dig into the numbers, right? We both did the underwriting early on. Now we have teams of it, but you still need to understand what's happening where and why, right? How are the numbers getting impacted? It's not about needing to be able to do integrals in your head, right? It's really not. It's simple, much simpler concepts, right? It's simple math, addition, subtraction, and this money happens and this thing grows this much and what does that do to the ROI? Understand those and then really apply the debt and then figure out, hey, is this a deal that should move forward with or not, right?
And one thing it goes back to that I'm going to add, right? It goes back to the earlier point where we were talking about, having good partners that have that net worth and liquidity. The lenders are going to expect that, right? You're not going to be able to take on bigger deals where you're going to be able to scale unless you have that in place. I think that's important. Another thing to kind of realize is what Ferris was alluding to is understanding where you're at in the market cycle. Right now, bridge loans, because interest rates have gone up and everybody's kind of spooked by, interest rates spiking. Bridge is kind of not in vogue anymore, but 2 years ago it was. And before that, it was all about Fannie and Freddie permanent fixed debt, right? You have to understand where you're at in the cycle, what your business plan is, what your partner's business plan, what your equity's business plan is, making sure there's alignment there, and then ultimately putting the right debt on. Because again, the one thing that people don't realize is you could be hamstrung. They're called the golden handcuffs, right? So say you've got great deals that you've increased the value on these properties tremendously. Well, if you've got a $3 million prepayment penalty from a Fannie Mae or a Freddie Mac loan, you can't sell the property for all that much profit, right? Then you're kind of handcuffs to the deal. So again, you have to kind of judge that based on where you're at in the market cycle, what kind of play you're doing. But that has allowed us to scale tremendously as well in the past too, is just putting the right capital stack together.
All right, next question. So over the course of our journey, right, what are some of the big mistakes we've made?
I think
Nice and
we've touched on it a little bit, right? I think, having the right or wrong partners, having the right or wrong capital stack. And I'd say that along the same lines as the capital stack, having the right lenders. I mean, these have been big problems of ours when we've had the wrong lender on really the right deal, right? You just didn't put the right capital stack together and they're going to try to jam you up. There is lenders out there that, they might be able to get the loan originated and get the deal closed, but they're servicing, which is the back part of the loan, and having to deal with them on a month-to-month basis is very challenging. And
there's loan-to-own shops out there
there's
too
definitely
that are
loan-to-own
just trying
shops.
to jam you up. And so lender really matters, right? And I'd add to one of the ones that Ben didn't mention is really just reserves, right?
Yeah.
We've made that mistake not having enough. We ended up funding ourselves because again, we had the wrong lender. They jammed up our reserves and we didn't have enough reserves to go deep. And so the whole thing kind of comes to a grinding halt and you have to make sure you keep it lubricated and got a bunch of jam.
Yeah, no, I think reserves are, especially in this day and age, right? You've got to have some money in the bank. Cash is king, as they like to say, right? Ultimately, it's like, okay, how do you recover from some of these things? I think ultimately the big lesson that you have to learn from your mistakes, right? I've seen people time and time again, they make the same dang mistakes over and over again. It's like, you got to get your head out of your, what, and understand that you can pivot and do different things and do them differently in order to be successful, right? And I think that that's the one thing that we're probably pretty good at is we've learned which lenders to use. We've learned how to, structure deals and what amount of reserves and capital we got to bring to the table. And we don't make the same mistake twice. So moving along, what systems and processes have we done to ensure us to be able to scale? And I think we've always looked at it through that lens too, right? And I think that's the one thing before we get into this question is that we were aligned in the sense that we always wanted to grow a big company. We wanted to scale a company, actually build a commercial real estate firm, which is what we've done.
And we were willing to continue to invest everything back in the company to do that.
Yes.
Because other partners might not have been, right?
That's true. And that's where it's so fundamental to have that alignment with your partner, because one guy might say, hey, we're gonna do a few deals and then I'm gonna go retire, to Costa Rica. And then this guy's like, wait, no, I'm just getting started. Well, you're gonna go sideways very, very quickly. So I think ultimately we knew where we were going. We ultimately reinvested a substantial amount of money into Disrupt to continue to grow it, right? But that was just one thing, right? We had to have the capital to be able to bootstrap this whole thing. Yeah. But and this is my systems and processes guy. What were some of the things that we did that I would say kind of helped us kind of scale?
I'd say the biggest thing, not even just for us, the biggest thing most people need to do is really clearly define boxes, right? Even us, we weren't good enough at that, right? But really, the more clear you get on what a person needs to do, the better they could do that, or the better you can be at trying to find the right person, right? And really just get that crystallized, right? For example, even asset management, what does that mean? We struggled with that one for a long time. Like, what is the difference? Where does the line for asset management stop? And where does the line for property management pick up, right? Starting to really spend the time and effort to try to clearly articulate those and force those people to spend the time and effort to define their process a little bit, right? And kind of that helps understand where the football gets handed off. And more importantly, right, start to measure those people for that, right? They know they're being held accountable to it and start to be able to be the best they can be at that role, right? Because then we're at a different phase now where people, I like to say this phrase a lot, people are turning into departments, right? So that's a different set of challenges because now those boxes need to get split up into sub boxes. And again, the same exercise needs to happen. And so I think really being clear, right? Things, whenever there's lack of clarity, people spend too much time context shifting, too much time stumbling on themselves, really, right? And the clearer you can be, the better it can be. Even being Ben, sometimes we have to be clear and just quick pause and say, okay, you're running with this, I'm running with this, I'm gonna stay out of your lane, you're gonna stay out of my lane. Boom, right? We're not double working things, we're not stumbling on each other, right? And you trust the other person to do the other part well and to their best and vice versa, right? And so again, it's about getting clarity. I think that is a big thing most partnerships struggle on.
So I mean, I would say the other flip side of this question too, right, is, and we get hit up on this all the time, like what software, what systems do we use, right, to help us kind of scale too?
Yeah, and I'll answer that, but I always like to say that's the wrong question, right? Because today, this day and age, there's a million ways to do the same thing. So my answer is it doesn't matter. Pick one and run with it, right? But for us, right, I mean, we were on, for the email that we had asked that one all the time, we were on MailChimp, and then we went to ActiveCampaign, and now we're on HubSpot. But again, there's not a right or wrong. There's certain reasons we wanted to move up to the next one, and those may or may not be applicable to you, right?
Yeah.
There's big companies that are on MailChimp. There's small companies on HubSpot. It doesn't matter, right? Similarly, right, you need to have a way to start to document processes. We used to use something called Confluence, and now we use a Trainual, right? Again, that's our hub of knowledge. And then the other piece of that too, right, is how do you start tracking the tasks? Well, everybody uses emails, right? But then the problem with emails, an infinite stream of data, right? How do you capture the important stuff? And so we used to use Asana, and really I'm kind of shifting the company around to a different model now that's a little bit more accountable. So again, it doesn't matter, right? It's about getting people clear direction, right? People know what they need to solve. People can easily organize themselves. All all of these tools work.
Yeah, and I think that's a great point, right? Like each company's journey is going to be different, right? And we use different things at different phases of our journey.
The phrase
too.
that I really like is how we got from there to here is not how we're going to get from here to there.
That's true, right? So I mean,
Ben will use that one in about 30 days.
Absolutely, we'll be repurposing that one, right? And I'd say the one thing too is getting more sophisticated with your investors, right? And really when we started off raising capital 10 years ago or so, it really was a lot more, I'd say, antiquated. It's gotten way more sophisticated. So we use
also simpler too.
Yeah, we use InvestNext, whereas before, I was emailing documents, people were sending things in the mail. It was just very, very just 1990s. And I think right now there's been a lot of money dumped into those investor management systems. And so pick one that you like. There's a ton of them out there. Cashflow Portal being another one that you can use to streamline and scale out that process, right? Because once you have 100, 200 investors, more than that, we've got more than that. Try doing K1s. Try keeping up with distributions. You're going to be just drowning in data and not doing it very effectively. So I think if you're ever going to want to scale to a larger scale, you have to invest in those types of systems as well.
Thanks for joining us today on Money Mondays. We do this every week. And again, we're here to share what we've learned, the mistakes we've made. So if you have questions, ideas, don't hesitate to send them to us. We can help make a future video just for you.
And like or share the video with someone who is thinking about getting into real estate or ultimately might be looking to invest in real estate. So leave us a comment with any questions, any topics that you want to hear from us in the future, and we'll see you next time on Money Monday.